With rates at historically low levels, investors are reaching for yield by allocating to higher risk investments. But we don't believe in sacrificing quality for higher coupon income, and it remains highly important to ensure portfolios are adequately diversified across regions and the capital structure. And one area that we like at present is Asia high yield. After being significantly oversold in early 2018, the asset class has continued to exhibit the characteristics that led to our move. Fundamentals have not deteriorated, spread per turn of leverage ratio is still attractive, and the asset class is relatively insulated from trade tensions given its domestic revenue bias in China. While we are near our lowest allocation to high yield since inception, Asia high yield remains a key area of conviction for us. We believe that hedges are an important tool for downside protection in volatile markets, and this was a key source of added value in the fourth quarter of 2018. But instead of being dogmatic in our approach, we seek to tactically adjust our hedging portfolio as pockets of risk or value emerge. While our net exposure was maintained in January 2019, we did reduce some of the stronger performing global equity income exposures, as well as some of our S&P 500 and technology sector hedges. This served us well in January, and we primarily reduced our downside protection in anticipation of a rebound from oversold positions after a difficult December, with the intention to reinstate the hedges if fundamentals didn't change. We invest across the full spectrum of global markets, including equities and a wide range of fixed income assets, from government bonds to high yield, EMD and loans, but also real estate, commodities and alternatives, such as asset leasing and infrastructure. We use infrastructure for its strong diversification benefits alongside stable inflation-linked return and yield. As the market cycle continues to mature and uncertainty is likely to remain high over the coming months, these assets have the potential to be particularly valuable given their low correlation to the wider market and more traditional asset classes. We believe that being cognizant of relative value opportunities across the capital structure and across regions within components of the capital structure is the best way of delivering on our objectives. We believe that our flexible asset allocation is a key competitive advantage, and we are supported by the deep pool of analyst resources here at Fidelity. An example of our flexible allocation is Chinese government bonds. During the key risk-off periods in 2018, correlations between global equities and the world's most widely used safe haven asset class, US Treasuries, were uncomfortably high. Chinese government bonds, on the other hand, managed to provide negative correlation to risk assets, but also finished 2018 as the best performing government bond market in the world. While we have stopped adding to this position, we still maintain an allocation.
投资一定有风险，基金投资有赚有赔。申购前应详阅公开说明书或投资人须知。